Everyone calls him the greatest investor who has ever lived. But in his own words, written in his own hand, Warren Buffett once described one single decision as the worst deal of his entire career. Not a small stumble, not a rounding error. A mistake so costly that its true price wasn't $400 million, it was billions. And here's the strange part. He didn't hide it. He didn't bury it in a footnote. He stood in front of thousands of his own shareholders, in writing, in public, and said it plainly. He had gotten this one badly wrong. Today, we're going to take apart that single decision, piece by piece, not to embarrass him, to understand something far more valuable: how the greatest investor in history handles being wrong, and why that, more than any winning trade, might be the real secret behind his success. If stories like this are the kind of thing you actually want to understand, not just admire from a distance, hit subscribe. This channel breaks these moments down every single week.
Let's go back to the year 2000. By the year 2000, Berkshire Hathaway isn't just an investment fund anymore. It's a sprawling collection of real businesses: insurance companies, furniture stores, candy makers, railroads. Buffett's philosophy has always been simple: find businesses with a durable advantage, something competitors can't easily copy, and buy them at a fair price. That's exactly what he believes he's found in a company called Dexter Shoe. Dexter is based in Maine. It's an old-fashioned, well-run American shoe manufacturer. Profitable, respected, with a loyal customer base and a track record stretching back decades. On paper, it looks like exactly the kind of business Buffett has spent his life searching for. Simple, understandable, consistently profitable. He doesn't just like the company. He believes it has something close to a permanent edge, a moat, in his own words, that would be almost impossible for competitors to cross. He is about to be proven catastrophically wrong.
And the way he pays for this mistake will end up mattering just as much as the mistake itself. In 1993, Buffett agrees to buy Dexter Shoe for approximately $433 million. Here's where the story takes its critical turn, the detail that changes everything that follows. He doesn't pay in cash. He pays in Berkshire Hathaway stock. At the time, this seems almost irrelevant, a technical detail, a matter of paperwork. Berkshire shares are simply the currency he uses. It's how he's structured other deals before. Nothing about it raises alarm. But think about what this actually means. He isn't just trading cash for a shoe company. He's trading a piece of Berkshire Hathaway itself, a piece of everything Berkshire will ever become, for a business that, at the time, looks solid,
but is about to face a threat nobody in the boardroom is fully prepared for. It's the equivalent of trading a share in a company that will compound for decades for a pair of shoes that might not last the year. And this single choice of currency is about to turn a bad deal into a historic one. Through the 1990s, something is quietly reshaping the entire shoe industry. Manufacturing is moving overseas, first to South Korea and Taiwan, then increasingly to China, where labor costs are a fraction of what they are in the United States.
Shoe companies that once relied on domestic factories are suddenly competing against imports that can be produced for pennies on the dollar. Dexter, with its Maine-based factories and American workforce, finds itself in an impossible position. Its durable advantage, the very thing Buffett believed made it special, turns out to be nothing of the sort. Brand loyalty and craftsmanship, it turns out, are no match for a $5 cost advantage per pair, multiplied across millions of units. Within a few years, Dexter's business is in free fall.
Sales collapse. Factories close. The company that once looked like a fortress crumbles into something with almost no value at all. By the time the dust settles, the business Buffett paid $433 million for is, in his own later assessment, essentially worthless. But here's what almost nobody talks about. The shoe company failing wasn't actually the expensive part of this story. What happens next is. Remember, he didn't pay in cash. He paid in Berkshire Hathaway stock. And Berkshire Hathaway stock did not stay flat over the following decades. It compounded year after year, becoming one of the most valuable equities in American history. So the real cost of the Dexter deal wasn't just the value of a failed shoe company. It was the value of everything those Berkshire shares would have become had they simply been left alone to grow. Buffett himself later did the math and stated plainly in a shareholder letter that measured in what he gave up, not the $433 million he spent, but what those exact shares eventually grew to be worth, the true cost of the Dexter deal wasn't hundreds of millions, it was billions. By his own account, Buffett has pointed to this as one of the single costliest mistakes of his entire career, not because of a bad shoe business, but because of the currency he used to pay for it. A failed business is forgettable. A failed business paid for with a piece of the greatest compounding machine in modern finance is a lesson that echoes for decades.
Here's what actually separates this story from 1,000 other quiet corporate failures that get buried and forgotten. Buffett didn't try to minimize it. He didn't reframe it or bury the number in vague language or quietly write it off without comment. In his own shareholder letter, read every year by hundreds of thousands of investors around the world, he described the Dexter acquisition, in his own words, as one of the worst deals he had ever made. He explained exactly why. Not simply that the business failed, but that paying in stock had turned a bad investment into a genuinely enormous one. At Berkshire's annual meeting, the event famously nicknamed
Woodstock for Capitalists, where tens of thousands of ordinary shareholders gather each year to hear directly from him, he's addressed it again and again, without deflecting, without blaming the shoe industry, without hiding behind hindsight. He simply owned it, completely, in front of the very people whose money was affected by the decision. That's rare. Most executives, most fund managers, most public figures spend enormous energy trying to explain away their failures, or quietly hoping nobody notices. Buffett did the opposite. He put it in writing, permanently, as part of the public record of his own company. So why does this story matter more than another highlight reel of his wins? Because it reveals something most people miss about how Buffett actually built his track record. It was never about being right every time. He wasn't. Dexter proves that beyond argument. What set him apart was what happened after being wrong. He didn't chase the loss, trying to win it back. He didn't let embarrassment stop him from naming the mistake publicly, in exact terms, with real numbers attached. And critically, he didn't let one disastrous decision change the discipline behind the hundreds of decisions that came after it. The lesson isn't don't make big mistakes. Everyone eventually will. The lesson is what you do in the years that follow one. Buffett's fortune wasn't built by avoiding failure. It was built by refusing to let failure go unexamined and refusing to let it define what came next.
A $433 million deal, quietly turning into a multi-billion-dollar lesson, not because the mistake was hidden, but because it wasn't. Most people spend more energy defending their mistakes than learning from them. Buffett did the opposite, and it may be the most underrated reason his record still stands unmatched decades later. If this kind of story is something you want more of, subscribe. Every week, we break down the real decisions, the wins and the losses behind the world's richest minds.